spreadsheet template designed to help you value a business and also to calculate how to finance the acquisition. I'm going to do this by using an example business, ABC Limited. So to begin with, I'm going to start with the setup page. And on the setup page, the first entry you have to do is to name the company. And whenever you select on a cell, one of these little yellow boxes will appear, which is to tell you what to do with that cell. Alongside of that, you do get a full user guide, but these are to help you on the hoof when you're looking at the spreadsheet. So the easiest thing to do is to move this out of the way so that it doesn't block where you're entering information. So to begin with, I'm going to enter the name of the company, which in this case is ABC Business. The next set of cells relate to the years, and these are going backwards in time. So year 1 is the most recent year, year 2, the year before that, and so on until year 5 being the oldest year. Now you can either leave these as year 1, 2, 3, 4, and 5, or you can put the exact year in. So for example, you'd put in 2025 if it was in the current year. This would be 2024, and so on. But I'm going to leave them as year 1, year 2, through to year 5 as it stands. The next selection is whether or not the business has an asking price or not. And that's key when you're deciding on how you found that business. So for example, if you found the business from a broker or online with one of the online websites, it's very likely it will have an asking price. However, if you've found the business by going directly to the owner using an off-market search, for example, where you've written a letter directly to an owner, it's unlikely that the owner will have an asking price as such. They may do. They may say to you, I want X amount for that business. And in this particular case, I'm going to demonstrate it on the basis that this business does have an asking price. So I'm going to change that to yes. And you have extra cells appear when it has an asking price, because then you need to enter the asking price in this cell here, which in this case is £750,000. And you may or may not want to enter it at this point, but you may have a preferred multiple that you would want to pay for a business. You may get a feel for the size of it, for the type of business that it is, and what sector it is in. Now I'm going to start off with a multiple of 3, for example, in this case. Now that's all I need to enter at this stage on the setup. So what I'm going to next do is to go to the profit and loss entry information. Now, to the right of the screen, I've got the years of this particular business, ABC Business, years 1, 2, 3, 4, 5. Now, ordinarily, when you get a set of accounts from a company or from the business owner, ordinarily, you would only have 2 years at a time on any set of accounts. So if you've got the most recent year, you would have, let's say that was year ended in 2024, or it could have gone into 2025. You would have let's say the year end was, I would say December. So the year ended 31st of December 2024 will be year 1, and year 2 will be 31st of December 2023. To get the information for the previous year and so on, you'd have to get the previous year accounts. But to make it easy for this demonstration, I've laid them out all on the same sheet, which you wouldn't ordinarily have, but it just makes it easier for demonstration purposes. So all you have to do is quite simply, you've got a line here called sales, and on the P&L account, you've got a line called sales. So you'd enter the sales in this cell here. Now what I'm going to do is I'm going to just enter year 1 figures for the time being, and I'm going to move this across as I did before. So the next entry is the cost of sales, and on here we've got cost of sales. So let's enter that in here. And just so you know, on the entries, you don't have to worry about whether it's a plus or a minus. Just enter everything as a positive. You'll notice on this P&L account, cost of sales is in brackets, which is effectively a negative. So it's denoted such that you take the sales less the cost of sales gives you your gross profit. But the AcquiCalc template will do that calculation for you. So just enter these as a positive. So the next entry is your expenses and overheads, which you go straight down to here. 793,386 and so on. And you'll notice that the profit and loss here will update each time you enter an amount. interest income. So in this case, we do have some interest income, which is 10,688. And we do also have some other income, £5,000. Now, what you're trying to do is to mirror the information on here. And I can straight away see, you probably already saw it as I was entering it, I've entered £160,000 in terms of sales rather than 1.6 million. But this is the point you stop and say, well, actually, does that agree to the figures on here? No, it doesn't. So let's go back and correct that. So it's 1,600,000, 1.6 million. And now we can see that the 166,302 is the same as the net profit on here of 166,302. And it's important you do that and to check that you've entered the figures correctly, as I just did. So the next entry is the taxation. And on here, that's in that year is 41,576, again, entering as a positive entry. And then dividends. And we've got a dividend here of £65,000, leaving you a retained profit in this year of 59,726, which ties up here, 59,726. Other entries that are useful to enter for working out profit multiples are either add backs or deductions specific to the business. So in this case, I want to enter the owner's salary and benefits. And the reason we want to know about that is because once a seller sells the business to you, they will no longer be there. So those costs disappear when that owner walks out the door. So in this case, on the face of the P&L, we can see director's remuneration, which would be the owner, we can see is £95,000. Now, there are other add backs that you might want to add back here, and that might come out as a result of a conversation with the owner and digging deeper into the information, which I've effectively done here. So I've got other add backs in this particular year are £5,400. Now, deductions. Deductions could include, for example, replacing the business owner with a person to run the business for you so that you're not tied to running that business. Or indeed, the other way to do it is to look at the employees that business has and ask the owner if there's anyone that could replace the owner or step up into that position to run the business for you, which would probably result in a pay rise. So that would be a further deduction. So in my case, what I'm going to assume is that I'm going to have to employ someone to replace the owner. And in this case, I've estimated their salary at £100,000. Yes, you say, well, that's more than what the owner was taking, but you want to be able to get a good person in. And also bear in mind, they probably won't be getting dividends because you own all the shares of the company. So I'm going to put in £100,000 in there. The other entry that you need to possibly enter, and I'll come on to why that's important in a minute, is the depreciation and amortization. We'll get that straight from the P&L. In this case, it's 39988. Interest costs, and the reason you add those back is because interest relates to loans, and normally speaking, the owner will repay those loans prior to you buying the business. So we need to add those back. So 10163, because those will no longer be there. And we may or may not want to add back the other income, depending on whether that other income will remain as the business goes forward. I'm going to assume that it does, so I'm going to put a 0 in there. And that's a good point. It's always a good idea to put a 0 in one of the cells so you know that you've considered it and you haven't just missed it. So if we now look at the P&L account down here, we can see that the turnover, sales, cost of sales, gross profit ties up to what is it on this P&L account, and so on. You go all the way down, you've got various adjustments, which then it gives you in green here is the adjusted EBIT, which is earnings before interest and tax. Adding back depreciation and amortization gives you adjusted EBITDA, which is earnings before interest, tax, depreciation and amortization. Now, there's a debate on which one you should use. In my opinion, it should be adjusted EBIT. A lot of people use EBITDA, so that it ignores or effectively adds back depreciation, when I don't think you should, because that's a real cost of the business. Yes, it's not a cash flowing item, but it's a cost of the business, because ultimately over time you will have to replace those assets out of profits effectively. Yes, you pay it out of cash flow, but you have to have the profits there to build up that cash in the first place to buy those assets. So that's pretty much it in terms of entering the profit and loss information. And just from that information and that quickly, we can get to a valuation. So in terms of adjusted EBIT, your profit is 166,177, which came straight from here, which is 166,177, which is your profit adjusting for these items. And remember, it's not adjusting for depreciation in this case. So we can see that the 166,177 here is pulled in from the profit loss account. And a 1 times multiple will be the 166,177 using the adjusted EBIT. And 2 times multiple will be 332,354. Or in our case, I selected 3 times multiple. We'll pull in this number here of 498,531, and so on down. 4 times multiple, 5 times multiple, and so on. And the green column here and the green heading is because here I've selected adjusted EBIT. But if I change this to adjusted EBITDA, you'll see that this column here changes to green. So a 1 times multiple using EBITDA is 206,165. 2 times multiple, 412,330, and a 3 times multiple, 618,495. So you can see just by this example that if we use adjusted EBIT, the business valuation is lower than if we use this adjusted EBITDA. And the reason for that is that with EBITDA, we're adding back that depreciation. So in this case, that's 3 times that depreciation. So you would end up paying more for that business than what I would consider what it's worth. So I'm going to change that back to adjusted EBIT. There are other options that you can select to value a business using AquaCalc. But of course, in this case, the business has been valued at £750,000. Even if we used a 4 times multiple, we wouldn't get to 750. And if we used a 5 times multiple, you'd get to £830,000. So let's jump back to the setup screen. This has now been populated by inputting that information. So the current multiple, based on £750,000, is 4.51. And in my opinion, for a business of this size, that's too high. So if we were to use the 3 times preferred multiple, that would give us a target price of 3 times, which is 498,531. So we would need to discount or effectively negotiate with the owner or the seller and get them to reduce what they want for the business by around £250,000. So that's how quickly you can assess a business's profits by just putting the information in to AquaCalc, and you can pull out the numbers very, very quickly. And that's how you work out how to value a business, but quickly and easily. So now we've valued the business, let's take a look at how we might finance that. Let's assume that we can negotiate with that owner down to just under £500,000 for that business. So the next piece of information we need to put in is to do with the balance sheet. And in the same way, I have a balance sheet here with all the numbers on it in the same way, years 1 through to 5. And again, you'd have the same scenario where you'd have to pull out information for the current year and the year before on one set of accounts, and then this would be for the next set of accounts, and so on. And it is a good idea to get as many years as possible, minimum 3, I would suggest, ideally 5 years of information. Because whilst on the one hand, that won't necessarily help you in the calculation of the valuation per se, which we'll come on to in a second, what it will do is it will give you information about how that business has traded over the last so many years. But anyway, let's have a look at putting the balance sheet information in. So the first entry is fixed assets, intangible net book value. NBV stands for net book value. Well, we haven't got any of those or that. I'm going to put a 0 in. The next one is the net book value of fixed assets, or tangible fixed assets, 159,952. Any property, we don't have any property. Long-term investments, we do. We have £150,000 of long-term investments. Cash at bank, yes, we've got a healthy bank balance, which is good to see, 681. We do have some short-term investments, £115,000. Stock or inventory, we've got 103,212 of stock or inventory. We've got no work in progress. Trade debtors, we've got 213,333. Other debtors, we've got some of those, 17,102. Other assets, we've got no other assets. We've entered all of those. We've got no director's loans receivable. In other words, what the director owes back to the business. Nothing for that. Then we've got trade creditors or accounts payable, which are 78,720. Sales and payroll taxes, 34364. Corporation tax, 41576. Other creditors, we do have some other creditors of 12,828. Nothing in there. There is a director's loan here at 23,715. And we do have some deferred income. Bank loans of less than 1 year, yes we do, £25,000. Bank loans of more than 1 year, yes we do, £100,000. And other creditors due more than 1 year, yes we've got £18,000. Just move that out of the way. So we're hoping that the net assets, this is a control difference here, but it comes to that difference, which is that. So all we have to do is enter shareholders' funds, which is this figure here, 633077, and that will come down to 0. So it will highlight any differences until you get that to balance. And if at the end of the day, let's say we'd missed that out, it would show that there is a difference to enter. And all you'd have to do is go back through your numbers to make sure you've entered everything, and you could come back and say, okay, I forgot to do that. So this entry here has got to come back down to 0. And that's it in terms of your balance sheet. You can check your report, and that all ties back to those balance sheets. And although this, I might have gone through that quickly, I'm doing that to show you how easy it is to enter the information. But all you have to do is to look at the heading here and match it up with the set of accounts, and just simply copy the entries across from one to the other, as we did on the P&L account or profit and loss account. Below the balance sheet are some graphs. Well, these aren't any good because we've only entered the current year. And similarly, below the P&L account, we have some graphs, but equally, because we've only entered the 1 year, that's not going to work. But I will show you how those work in a minute by putting all the other information in. So in terms of financing the business, I'm going to open this up. We don't need the P&L account and balance sheet details anymore. I'm just open this up because it's slightly wider. Now, it's important to understand that there's 2 types of valuation of a business. There's the enterprise value, which is the same in terms of the profit multiple, which in this case was 498, or that's what we were hoping to do, 498,531, which is a multiple of the profits, and that's also classed as enterprise value. But then you've got the equity balance to finance. And equity is in terms of the net cash that's in a business. Ordinarily, when you buy a business, you buy it net of any cash or cash equivalents, cash in the bank, investments, short-term investments, those type of things, less any liabilities that are deemed to be net debt. For example, loans, corporation tax, and that type of liability that you wouldn't expect to take over as a business owner. You wouldn't want to be taking over liabilities that relate to the business that you've just taken over. However, there is a subject to on that, because you can, where it's beneficial to you and it works out, keep those liabilities and keep the cash in the business, because if, for example, you've got a loan there that's already been approved and that loan is on very good terms, and as long as it's not been personally guaranteed by the directors, maybe it's secured on the assets of the business, why would you want to repay that? So in this case, actually, when we look at the balance sheet, we've got £125,000 of liability that is being paid over time, and we could retain that in the business, £125,000, or use that to pay the deposit to the owner, and then we pay it over time, because then you don't have to reapply for a loan, and if it's on favourable terms, then keep it. However, as I said, if that loan was personally guaranteed, you'll probably have to repay it, because the director previous owner won't want to have any personally guaranteed loans of a business that they don't own and control. So our first step is to look at financing the enterprise value, or the actual profit multiple. So one way to do that would be to say to the seller or the owner is, would you accept seller financing? So we could possibly finance the whole lot of that. And let's assume that we do that over 5 years on a monthly basis, so you pay it monthly. Let's assume we agree a 5% interest rate, and that's all negotiable. And let's just put an amount in there of 498,531. And that's that done. That's that fully funded. We'll come back to other ways you can fund that, because we've got bank loans, we've got factoring, we've got other types of lending and so on. But what we can see down here is that the enterprise value side of that business has been funded. So we have our asking price, we've got the discount, and it will show you the discount percentage, 33.53% off of that, bringing you down to 498,531. Of course, that's a negotiation to have with the owner. And then we've got seller finance, 5% over 60 months, 498. So that's been fully funded. So now we need to look at the equity balance to finance and work out where this 252,562 has come from. For that purpose, we need to go to the assets and liabilities worksheet. So let me explain what this is. So what this has done is it's pulled in from the balance sheet entries all of the numbers. So if you remember the 633077, if we just go back to the balance sheet just to show you, 633077, which is the total of the balance sheet, and that's pulled in all these numbers from there. Now, prior to that column, you've got an asset or liability type. So you've got various types of asset and or liability. So for example, your assets or fixed assets, we call them structures. So they form part of the business, and they would come with the business. So you wouldn't expect to buy a business that's got, let's say it's got machinery in a factory, for example, that make or manufactures the items that the business sells. You wouldn't expect to have to pay for those separately. They will be formed part of the business and part of that profit multiple. So they are structure. You've then got something called net debt. And net debt is effectively what we're saying is that any assets and or liabilities that aren't part of the business going forward. So for example, in this case, we've got a long-term investment. You wouldn't expect the owner to sell that with the business, because if that long-term investment wasn't there, it wouldn't affect the trading of the business. So that effectively belongs to the owner and should be paid for separately over and above what you pay for the business or the business profit multiple. The same applies to the cash at bank. And we'll come back to that, because that doesn't always apply that the whole amount gets paid to the business owner. Similarly, short-term investments. Without those, the business would be able to carry on running. Then we have what I would class as working capital. So things like your stock, work in progress, trade debtors or accounts receivable, possibly other debtors. It depends upon the other debtors and those type of things. And similarly, in liabilities, we also have working capital, trade creditors or accounts payable. Sales and payroll taxes would be classed as working capital. And again, a bit like the structure or the main assets that are there to, let's say, manufacture what the business makes, or it could have vehicles that are key to that business. The working capital is part of the business. It's intrinsic to the business and it's operating. So you would expect that the accounts receivable, the accounts payable, and all those type of things are part and parcel of the business. You expect to pay for those and they be part of the business. You wouldn't pay any extra or any less for those. They'd just be part of the multiple for the business. But then when we come on to other types of liabilities, like corporate taxes, in this case, we've got £41,000 of corporate taxes. Those taxes are due to be paid on the profits that have already happened. So that's a liability that would go or stay with the owner. It would have to be paid out of this cash at bank before the business is purchased. And these various other liabilities are deemed to be part of net debt, and it's an adjustment down to this 252,562, which we saw, on the financing, 252,562. So what that 252,562 number represents is all of those effectively cash and cash equivalents, the investments and the cash at bank, less all the liabilities that should be paid off before the business is sold. That's the net amount. So in theory, at this point in time, we would owe, in the valuation we put on that business, pay the owner another £252,000. Well, that's not a problem at the end of the day because the business has £252,562,000 effectively in the bank, less those amounts there. So that's not a problem. However, let me just stop there for a second. Now, ordinarily, if a business owner has something called a pre-sale dividend, in other words, just prior to sale, the business owner removes that amount of cash, effectively pays off these liabilities, and that would leave them with net cash in the business of £252,000. If they pay themselves a pre-sale dividend, they would have to pay tax on those dividends, which if the business owner is happy to do, then that's fine. However, there's another way around that. And what we can say is that we effectively add the £252,000 to the value of the business, and we pay the owner for that as part and parcel of the purchase of the business. And ordinarily, you get a tax break for that, or certainly the owner would get a tax break for that, because you pay less tax on capital gains, which is what a business sale is, versus income or dividends. So it could be in the owner's interest to say, well, okay, I'm going to receive that as part of the sale proceeds. And again, that's down to a negotiation. So what you can do is you come over here and you change cash at bank to cash adjustment. And what that does is it moves the whole of the cash balance across to cash adjustment. But what it also does is to move all the liabilities across to the same column to avoid you paying out all that cash and not taking account of these various liabilities. However, the slight problem is we've also got two investments sitting under net debt. So we need to also move those across to the same cash adjustment column, because effectively these are cash. This one's a long-term investment and this one's a short-term, but essentially they're cash, or what's called cash equivalents. So let's just change those two. That one, let's just move this out of the way. And that one. So you can now see that the total of this column is now 252,562 instead. But what that's now done is it's transferred that amount of money to the deposit worksheet. So this amount here, the 252,562 amount to finance, is a deposit amount, but it's not coming out of your pocket. It's coming out of the business to effectively pay for itself. And by paying it as a deposit as part of the total sale proceeds of that business, the seller is not paying it as a pre-sale dividend. So let me just put in that figure there, 252,562, and that will bring the fully funded deal down to zero. And I'll take you now to the financing worksheet. And you can now see that in that column, the green 252 figure has completely gone, which means that the deal is fully funded both on enterprise value and equity value. And that's probably a good point to pause just to understand the difference between enterprise value and equity value. And a good way of doing this is to think about buying a house. So if you were to buy a house, the agent would value that house at, let's say, £500,000. That's the value or equivalent to enterprise value. However, if the house that you're buying has a mortgage secured on that property of, let's say, £250,000, when that house gets sold, although effectively you'll be paying across £500,000 to the seller will only get in his bank account half of that, i.e. less the mortgage, so £250,000. So the equity value is the enterprise value less any outstanding liabilities or debt, which in the example I'm giving with a house is £250,000. Now with a business, equity can go both ways. To give you an example similar to the one I've just described using a house, if net debt, i.e. cash in the bank and cash equivalents, less liabilities was a negative figure, then that would work in the same way as a house. So you'd value the business as a business multiple, and then you deduct those liabilities, and that would be the amount that the owner would get. The enterprise value is down to negotiation, and although the equity value is also down to negotiation, essentially if the deal is to walk away with no cash, no debt, and that was a negative figure, the business would be sold for the enterprise value less that net debt figure. But with a business, as I was saying, and in this example, that can go the other way. So if the cash or cash equivalents is higher than the liabilities, which is the case on this example, then that will add to enterprise value. So it'll be the enterprise value, which is the multiple, plus the amount equivalent to the net amount of cash in the business. So now we've done that, we can come down to the report, and you can see the enterprise value, which is the asking price less the discount that we're saying should be given on that business to bring us down to our 3 times multiple of 498,531, which has been fully financed, in this case by seller financing. You won't always get that, but I'm using that as a quick example of what you can do. And under equity value, you've got a deposit of 252,562. So that's also fully funded, showing here in this line that the deal is fully funded. And then the system will break out when these amounts are paid for that business. Below that, we have the net cash flow profit. Try quickly jump across to the profit and loss account. Is this figure here, which is your adjusted profit, adding back depreciation because that's not a cash flowing item, less the tax, and that gives you your net cash flow from the business. So the business uses the latest year of profits to calculate the net cash flow. And then what's deducted from that is the loan repayments. And in this case, it's seller financing paid over 5 years, which gives you your net cash flow post-funding costs, which is £50,000 annually or 4,308 per month. And to the right, it will give you your debt service cover ratio. Now, a minimum really you want is 1.25. So this is above the minimum, 1.46. But some prefer 2, and even some banks, if you're borrowing from a bank, will prefer 3 and above. Now, 1.46 possibly is a bit on the low side, although recommended is 1.25. And the easiest way to increase this in this example, if we keep with the same seller financing, is to increase the period over which that's paid. So let's take that up to 6 years or 72 months, and AcquiCalc will automatically recalculate that. So now your loan repayments have gone down to £96,000 a year, and your net cash flow after loan repayments has gone up to 68,000, and that's now just over 5,600 per month. And it's increased your debt service cover ratio to 1.71. So let's take that up to 84 months. And that's now taken the debt service cover ratio to just under 2. So you may be comfortable with that. And that gives you, after loan repayments, an amount of £80,000 per annum from this business. Now that does mean, of course, it takes a lot longer to pay that off to this seller. But one extra function that AcquiCalc has is to say that you might think, well, actually, I can improve the sales and I can improve the profitability of that business by putting in a percentage here. Now, certainly when I bought my business, I increased it significantly from a similar amount to what this business was making per annum. In other words, £1.6 million of sales and around about £120,000 of net profit, to nearly £3 million of sales and over £250,000 in profits. So let's just be conservative and put in 5% increase and show you how this will affect your funding going forward. So in this case, in year 2, your debt service cover ratio has gone over 2, increase to 2.5, 2.25, and so on. But what it means in terms of net cash flow profits is that you can see that they're increasing 80,000 to 88 to 96 to 105 and so on. And if we were to say, well, okay, I think I can increase that by 10% a year, that looks a whole lot more positive. So by year 7, you're pulling in £200,000 of profits, even after paying back the seller finance. And then in year 8, you're up to £320,000 in net cash flow profits. So let's now have a look at other ways that this business could be financed. So what I'm going to do is I'm going to delete the term there, seller financing, and I'm also going to delete the amount of the loan, and I'm going to delete the start date. So now we're back to having to fund the total valuation that we've put on this business of the 498,531. So when we go back and have a look at the balance sheet, we've got some tangible assets. And let's assume that's equipment. Let's assume that there are no loans outstanding on those assets and there's nothing secured on it for this example. And let's assume of that 159,000, £100,000 of that could be asset financed. And asset finance is a very easy and quick type of finance that you can get on assets that are unencumbered or they don't have a loan secured against them. And you can sometimes get 60, maybe 70% of the value of that asset according to the finance company. It's not what the value is in the business, it's what the finance company deems that asset to be worth if they had to take that asset back to pay back the loan if the business defaulted on it. But let's assume that there's some assets in there that the asset finance company will value at £100,000 and they're willing to give you 70% of that. And as a side note, you can arrange these prior to buying the business, as long as you work with the seller, of course. And those loans can pay out or complete on the completion date when you buy the business. So if we come back to here, let's assume that the first one is a 60-month or 5-year loan. Let's also assume that that's an 8% loan and the amount of funding is £70,000. In other words, 70% of £100,000. There's no personal guarantee. It's a bank loan, interest only loan. You've got the option of saying interest only or roll up. Roll up is that there's nothing paid until the very end. Interest only would mean that you pay interest only. But I'm going to assume that this is a capital and repayment loan. And I'm going to say that it starts in month 1 and the drawdown is in month 1. So what that's done is it tells you how much the repayment amount will be, which in this case is £1,400 a month. And it's reduced down by £70,000 what's left to fund. So we can have a look down here. So in this column, we've got £70,000 and we've got balance of funding required, which is in this column too. We can then look at possibly factoring, because on the balance sheet, we have some accounts receivable. And again, with a side note, with accounts receivable, you can only factor invoice finance if it is a business to a business type of company. If the business is direct to consumer or B2C, as it used to be called, then you can't raise invoice financing on those. But let's assume that this business is business to business. And let's assume that the factoring company will finance up to 75% of the accounts receivable. So I can't do that in my head, so I'm going to bring my calculator across here. So I'm going to take 213,333 times 0.75, which is 75%. So that's 159,999. So let's assume let's round that up. That's £160,000 that we can finance on invoice financing. So we go back to our financing screen and let's assume that the interest rate on that is, let's say, 7.5%. It's secured on trade debtors. The amount of financing is £160,000. There won't be any personal guarantees on that. It's very likely. In this case, the type is factoring, and you have a service fee, which in this case I'm going to assume is 0.5%. And I'm going to assume the whole of the sales are able to be factored. So that's 160,000. And the service fee is based upon the volume of sales. So that will be an additional charge over and above what you're effectively borrowing, which in this case is £160,000. And I'm also going to say that the drawdown month is month 1. So now we can see that our amount to finance has dropped now to £268,000. So this will be down to a discussion and negotiation with the seller. If you want to have a situation whereby you don't want to put any of your own funds. However, what we do have as part of this business, we have some deferred revenue. Now, again, this is one of those items that is a negotiable item. Your stance on the negotiation with deferred revenue would be that the whole of the amount, in this case £160,000, is a liability, whereas the seller will want that to be part of working capital. What that means is that they will be saying, well, effectively, yes, customers have paid some of that money to us, but it won't cost you or the business that amount of money to deliver those services. Whereas your stance is that effectively, if all of those customers wanted their money back, you would have to pay it all back. So you would start off by saying, no, I would like to keep all of that £160,000. And what that will do, if we go back to the assets and liabilities, move that out of the way, the deferred revenue here, as we saw before, it reduces down the amount of cash paid over to the owner. So that's not a liability in the same sense as, let's say, this corporation tax amount, where that amount of money will have to be paid in due course. This £160,000 is effectively sitting in the business's bank account on account of doing that service in the future. So it's not going to be repaid anywhere. It's just representing the amount of money that the business holds from those customers. Now, there is a middle ground here. You might agree with the owner that, let's say, a portion of that, let's say 25% of that, is deemed to be working capital. So if you agreed with the owner that £40,000 of that should be paid back to the owner, if we put in £120,000 in here, what it does is it will reduce this number down to 120, and it will transfer £40,000 to working capital. So it will increase the amount of cash effectively that is available to pay back to the owner by £40,000. And if we came across to the deposit, we'll have to increase that. So I'll delete that and then put in the new figure, 292,562. Okay, so that takes it back to what it was before. Now we've got an amount here, amount to finance. We can use some of that £120,000 we've negotiated to keep as part of the deposit, because as you are going forward, to argue from a seller's point of view, that £120,000 is in the bank. Yes, you'll have to probably buy materials, pay for labour and so on going forward, but that will also be funded by the business as it goes forward too. So you may not want to set aside all of that money for deposit, but there's nothing to stop you putting some of it into a deposit to the business owner. And let's assume that we put half of that in, so that's £60,000. So that now reduces what we owe to the owner to £208,000. So we're getting there. We're reducing down potentially what we'll ask the owner to put as seller financing. Now, another very useful function of AcquiCalc is to say that we're going to assume or retain some or any of these liabilities. Now, one liability that is quite a good one to retain is loans. Now, this will only work if that loan is not personally guaranteed by the owner. And it might be that it's secured on the business as a whole. But let's assume for the purpose of this that it is not personally guaranteed and it's got favourable terms. So if it's got favourable terms and it's paid over a period of time, why would you pay that back? And that could be used to pay the deposit. So if we change that to assumed meaning that it's retained, it transfers it across this column. And whilst it transfers those amounts to this column, which I'll explain the importance of that in a second, equally what it has also done is it's still deducted it from the net adjustments. Because those liabilities are still there, they should be repaid, but you're taking them on, you're paying them off over time. But what that has done now, if we go back to the deposits worksheet, you can see now it's pulled in that assumed debt. So we've now got £185,000. And if I delete the £60,000 that we put in before, which was part of the deferred revenue. So we've now got 120 plus 125. So we've got £245,000 there that we can put down as a deposit to the owner. So I'm going to argue that we could put down £200,000 under enterprise. So that brings down the amount to finance to £68,000. But it still leaves you £45,000 in the business, cash on completion. The business owner gets a total of 200 plus the 292, but it leaves this amount to finance. So what we can now do is move back to here. If we put that over, let's say 3 years, 36 months, the amount to finance is this 68,531, and that now is fully funded. Our repayments are 2053. So again, we have a fully funded deal, and it will summarize how that's been funded, your deposits that were pulled through, the 492 paid to the owner, which, remember, at this point is purely paid out of the business. The business is cash. We've got our bank loan, which is the asset finance. We've got our invoice discounted amount, £160,000, and then we're left with a balance of seller financing. And I would argue that many sellers wouldn't object to a small amount of money, which in this case is 8.66% of the overall price to be paid as seller financing. But before we look at the loan repayments and the impact of the changes we've just made to the financing of this business, there's one further thing we need to do. Now, if you remember, I changed on the asset and liabilities these two loans to being assumed, i.e. assumed at close, or effectively retained. So what we need to do is over here we have net debt liabilities assumed. Once you change those to assumed within the asset and liabilities, they appear here. So I'm going to pull those through. So I'm going to pull through the loans due in less than 1 year and the loans due after 1 year. Now effectively they're the same loan, but they're just split out within the balance sheet. That's a normal thing to do. So the total of those two is £125,000. Now I know that the loan term is 60 months because I've got that information about this business. Now what I'm going to do, instead of putting in the information for the two separate lines, I'm going to put it all on the one line because essentially it's one loan, but we need to pull them both through for the template to work. So I know it's a term of 60 months. It's an interest rate of 5%, and the amount retained is the full £125,000. Now it will give you this strange error here because this one is under by 25,000 and this one is over. But as long as the two of those match off, it's not actually a problem in this scenario. And it's also highlighting I need to change this. So what the template has done is calculated the loan repayments, which in this case is including interest. So I need to enter that number in there. So 2358.9, and that'll get rid of that error. So now that I've entered that information, I can scroll down to look at our debt service cover ratio and our loan repayments report. So you can see that the net cash flow post funding costs is slightly lower in the beginning stages because of course you've taken on these debts. There's a benefit to that because if the owner was reluctant to take a larger amount of seller financing, we've restructured it such that we've put in different lending and different ways of financing that business. We've increased the amount of deposit, but then we've also introduced a bank loan, we've got the seller financing, and also we've assumed the existing debts and debt repayments. So what you can see is that the beginning net cash flow amount is slightly lower than before, and I've taken a screenshot just to help you look at those side by side. So whereas before we had a net cash flow post funding cost of 80,000, that's now reduced to 74, and this was 96 and 90 and so on. So whilst it's a bit lower in terms of cash flow, and that's largely because of these factoring fees. So because we factored the accounts receivable, that's actually quite an expensive form of financing. And I wouldn't necessarily recommend it, but it just goes to show there are very creative ways in which you can finance the acquisition of a business. And this will all come down to negotiation. And just so you're aware that bank loans, whether it's asset finance or bank loan to purchase the business as a whole, factoring or invoice discounting or invoice financing can be done prior to acquiring that business. They will require the input from the existing owner and, of course, cooperation. But why wouldn't they cooperate if they want to sell the business? And I remember I did this, although the transaction didn't complete, I'd arranged asset finance on the equipment of that business. It was a civil engineering business. I'd arranged invoice financing on his accounts receivable because all the clients were businesses, so it was business to business. So what I wanted to get across by showing you a different way of financing this same business, by having a template like this or creating one yourself, will make it far easier to be creative. So you can use the template one to value the business, and then you've got concrete numbers to go back to the owner to show them how you valued the business based upon the numbers in their accounts over 3 to 5 years. And then you can show them how you're financing the acquisition, and so that you can then negotiate between you how that can be agreed. But you can see I've given you 2 examples here, both of which are fully funded by using the assets and the cash within the business, both of which do require a certain level of seller financing, but neither of them required any money up front or no deposit by yourself with these businesses. Now you might say, well, these are example businesses, but I have dealt with businesses where you can acquire them for very little money up front. I've recently been involved with selling a business which sold for £1.6 million, and the deposit paid by the buyer was just £75,000, which is very small in comparison to the value of business that they've purchased. I was also recently involved in selling another business, albeit a lot smaller, but their deposit was just £10,000. So you can see that you can negotiate these deals. Now, looking at the debt service cover ratio of this new arrangement here, our net cash flow debt cover service ratio has reduced from what we had before, but it's still a good ratio of 1.83. Under EBIT is 1.85 or EBITDA 2.29. And by year 2, we're just around about the 2 mark, which is a good level to aim for. And then it goes over the 2 in the following years thereafter. And then below that, you have the loan repayments that breaks down this 69,986 here. This is the total, and this is how it's broken down. So you've got your asset finance at the top, the 17,000. You've got your seller financing repayments, and then you've got assumed loans that we calculated there, giving you a total loan repayment amount. What you can do this on the hoof with the seller in front of you, working out between you what works for both sides. First stage being obviously to agree on a purchase price, and I'll come back to that in a second, and then how you're going to finance that. You can ask the seller not what they want, but what they need right now. So they may need X amount of thousands of pounds right now, and then you can work out the deposit required, split between if you have to put some money in yourself and what the business has in terms of cash in the bank and cash equivalents like investments and so on. And then you can go from there to work out how to fund the balance. But always bearing in mind, it's the business that needs to be able to afford the repayments of whatever loan it is, be it seller financing, bank loans, etc., that's got to be able to afford those amounts of repayments going forward. And if your debt service cover ratio isn't within a comfortable level, it means that you just need to spread those repayments over a longer period of time, or put down a higher deposit, hopefully working out how you can increase that from the money sitting within the business, either as cash sitting in the bank, investments, assuming debts or liabilities, as I've already explained, and also if they've got some deferred revenue that you can use within the business. But there is one further negotiation that you need to think about when you're buying a business. And let me explain what that is. On the assets and liabilities, we may want to look at working capital months that we want to retain within the business. Think COVID. Now, if you bought a business just prior to COVID, and if that business had to shut down through the lockdowns and you weren't able to trade, It may well be that you still had certain costs going out. For example, rent. You may have had to keep the factory warm so it doesn't freeze if it was over the winter months. You may have to pay a certain amount towards your employees, because although there was the furlough scheme where the government paid towards those costs, they didn't pay 100% of those costs. So you need to think about how much cash you want to have sitting in the bank to be secure. Now, again, that's down to negotiation, because the seller might say, well, that will be down to you. But you might say, well, actually, what happens if on day one the business has to cease trading for a period of time? I need some cash in there because it's in both our interests, particularly if you've got seller finance. And this is another reason why you'd want seller finance. If you want that seller finance repaid, we need to make sure the business keeps going, and that's in both our interests. So that's your argument for making sure that everything you do is to secure the longevity and the future of the business that you're buying, but it's in the owner's interest that it does that too. So I would argue that you would look at probably 3 months minimum, and then we just have to decide whether we withhold that. And if I change that to yes, what happens is, if I just scroll down here, it will do a calculation for you. So it'll pull in the expenses or overheads straight from the profit and loss account. So that's 793,386. If I go back to the profit and loss account, it's pulled in this number here, which is what we put in earlier on, 793,386. It will then add back various adjustments, which all relate to the adjustments that you put in here. So it's all of these adjustments, bringing you down to a net 12-month cost post-takeover. Now, you can have a cost of sales adjustment and you can have an expense of overhead adjustment, but I'm going to ignore those for the purpose of this demonstration because I don't want to overcomplicate it. And then what AcriCalc will do is say, well, this is the 752,998 is the overhead cost for 12 months. So if I divide that by 12 and times by 3, but it rounds it up, that would be an amount of money that we have to retain, £190,000. And that is deducted from your net debt. So that would mean that instead of paying the owner £292,000, we now only have to pay them £102,000. Now, there's an additional thing that you can do. That's why I brought this in here, is you can include that in the deposit. At the moment, we haven't included that. But if I change that to yes, what it will do is it will pull that amount in here, working capital cash, so it gives you an extra availability of cash that we've withheld within the business effectively on completion. So it does mean that we could, if we wanted to, use that as part of the deposit. But what we need to do is adjust that down to the 102,562, which is the equity increase, because of course that's reduced now because we've reduced the overall equity adjustment by £190,000. So in terms of the financing, we are still fully financed because now the target price hasn't changed because we haven't adjusted that. But what we've done is we've reduced down the equity value adjustment by £190,000. So I just reduced the amount of deposit required. So if, for example, the owner didn't want any seller financing, I wouldn't recommend that because you need to hold some money back. And in fact, I would feel uncomfortable just holding back £68,000, but I've just used this for demonstration purposes because you need to retain an amount of money that you're paying the owner back just in case something crops up. Let's say something came out of the woodwork that the owner should have told you. Let's say there was a tax liability that came up. By having an amount of money that is owed to the seller, you can just deduct that from what you pay the seller. As long as that's written into the sale and purchase agreement, there's no problem with doing that. And that's far easier than having to go back to the seller and say, well, actually, there was, say, £50,000 that came out of the woodwork, and you've now got to get that back from the seller. And I much prefer having control of what you have to pay the seller. But in any event, what I wanted to demonstrate is that if, for example, they didn't want any seller financing for whatever reason, if you go back to the the numbers here, and if we delete that, so we've now got this amount to finance. So now what we want to do is to increase that to 268,531 because we've got additional cash sitting in here. But what is good is that we've now effectively retained cash on completion of £356,000. And the owner's happy because he gets paid everything up front. So he gets paid a deposit, which is split between the amount of deposit you've effectively retained within the business through liabilities and deferred revenue. And then this amount of cash is from the investments that were sitting in the business, so £371,000. This finances financing on the equipment, and that would be paid on completion, and also invoice discounting, and that will be paid on completion. So the owner walks away, everything paid up front of £601,000. Now, again, I don't recommend that, but that is a way of financing the business. And then you have sitting in the business £356,000 to run that business going forward. So worst case scenario, if you did have a COVID situation, you do still have some cash within the business. However, as I said, if something crops up where you need to try and get some money back from the seller, you're going to have to rely on the fact that the seller will repay that. And the problem is, if they've gone overseas, they've gone off into the sunset with their £600,000, and it'd be much more difficult to get that money back from them. So another worksheet to highlight is the highlights worksheet. And what this does is it summarizes the whole acquisition. So it'll give you your acquisition price, or what is effectively your target price. It will bring in your equity value adjustments, which in this case has been reduced down to the 102, and then your total price on acquisition, 601. And then that is broken down between how it's paid cash, loans, factoring. And if there are any properties within the business, these will be split out here. And AcquiCalc has various ways of treating those, whether you buy the property as part of the acquisition and borrow money against that property, or if the property is sold to the owner prior to completion, or in fact, if you bring in a property investor to buy that property and lease it back to you. This template will deal with all of those aspects. Then it will summarize your multiple and then the funded from the business, cash retained, and so on. And it also show you your net debt, liabilities retained, and your working capital for the last 3 years, and which is a very useful summary. And that picks that up from here, which gives you your normalized working capital workings. This is an important figure to make sure that the seller hasn't been manipulating the working capital. So, for example, one thing that they could be doing is delaying paying their suppliers, so that causes strain on the business. They could also be manipulating the stock or inventory, so that could be reducing significantly. So when you take the business over, you could end up with stock outs or stock shortages, which is something you want to avoid at all costs. So this will summarize to make sure that your normalized working capital looks reasonable. And then finally, on the highlights worksheet, you have something called the Ackman negotiation model. And where I first came across this is in the book by Chris Voss, which is Never Split the Difference. And the idea behind it is that you have a target price, which in our case is the £498,000, but your starting position is 65% of the target price. And I say position because you don't want to be the first one offering. You want to make sure that it's the owner that goes first on any negotiations of telling you what their target price is. Because if, for example, they came in lower than your calculated target price, then you're already ahead of the game. Now, in this case, we did have an asking price of £750,000, and more likely that was set by the business broker. And just because there is an asking price doesn't necessarily mean that the owner or the seller agrees with that amount of money. So it'd be useful to ask the owner, do you agree with the valuation? Then they may say yes or no. And then you can ask them perhaps to justify that amount of money, what multiple, how do they arrive at that price, because your numbers have been carefully thought through by using this template. And you can show them how you calculated the adjusted profit and what multiple you've used, and how reasonable that is based upon the type of business, the sector it's in, how many years it's been trading, and all the other metrics that go into working out a multiple. So the way you work through the Ackman negotiation model is, for example, if the seller is reluctant to come forward with a price that you're willing to start at, you can do a soft offer. And what I mean by a soft offer, so instead of offering £324,000, which is the 65% of your target price, you could say, for example, businesses of this size and in this sector often go for around about a 2 times multiple. So you're not directly saying, this is what I'm offering, but you're suggesting to the seller that that's what this business could be worth. Of course, they may come back to you and say, well, actually, I don't think it's worth that. I think it's worth at least X. And it might be £450,000. Now, bingo, because that's lower than your target price. And that's not to say that you would necessarily go straight to their figure. You could carry on negotiating. Now, I do recommend you do read Never Split the Difference by Chris Voss. There's a link below this video. I do recommend you read that book. So your next level of offer price will be 85%, which in this case is £423,000. And your third offer will be 95%, which is 473, and then ending up at £498,000. So there are many ways to finance a business. And you have so many different options on here, different bank loans, family loans, putting your own money in, seller financing, invoice financing options, a lump sum seller financing, and seller financing paid over a period of time. So you could include both options there. One of those businesses that I was recently involved with selling, they are paying lump sums over a period. The first lump sum is 2 years post acquisition, for example. And you can enter those here. And then, of course, we've got those net debt liabilities assumed as well. So now to show you another feature of AcquiCalc, which is very useful when you're analysing a business, but also it will help you direct some of your due diligence questions for that business. I'm going to enter the information for the other 4 years, so years 2 through 5. So now that I've entered all the information for all 5 years of the profit and loss account, we can now come down to have a look at some of the ratio of margins that are included with AcquiCalc. So first of all, we can see that it shows you what the break-even sales are. And what that means is that's the minimum level of sales that the business requires in order to cover its overheads. So it'll make 0 profit and 0 loss. And knowing your break-even sales is a key indicator for a business's viability. So in this case, in year 1, our sales are 1.6 million and our break-even is 1.344 million, that is. So we are sufficiently above the break-even point. And that applies in year 2. But year 3, there is a problem there because we can see that in that year, the business did actually make a loss of £17,000. So if you look back to year 4, we had sales of 1.5 million, that dropped to 1.297 million. So we need to ask questions of what happened there. Fortunately, it did recover. Maybe they lost a major client, but that needs to be highlighted and looked into. The next ratio it highlights is the business's gross profit margin, which in this case is very healthy because in year 1 is 59% and it never drops below 56%, even in the bad year. I recommend that you don't buy a business with a gross profit margin of anything less than 40%, because otherwise the business is very vulnerable to downturn in sales. So you should be aiming for 40% and above. And the higher the gross profit margin, the better. But this will straight away show you what the gross profit margin is. It'll also highlight what the profit margin is. And ideally, that needs to be 10% or more. So in year 1, that is just over 10%. Year 2, it's dipped below 10%, and this will highlight it by changing to a different color. And here we can see that it went into loss. So that's highlighted in red there. And in years prior to that, it was 13.7 and 12.5%. So 10% or higher, and ideally if you can get a business that's making 20%, even better. This will also show you whether the sales are increasing or decreasing. Well, we know in year 3 that it decreased, and there it increased by 19%, which is exaggerated by the fact that it decreased and it jumped back to normal levels, and then it's gone up by 3.4% there. So that might be your guide as whether you can put in an increase of, in our example, we tried 5% or 10%, but you may think, well, I know how I can grow this business because of X, Y, and Z. So then it will also show your profit increase or decrease. So it decreased here by 100%. And in this case, a loss decrease. So it went from a loss back into profit. So that's a very high jump there. Below that, we've got a number of graphs. And graphs is a much easier way for most people to visualize what's going on with the business. And just to note that the graphs are represented from left to right. So now the leftmost column is the oldest year and the rightmost column is the most recent year, because you can see that 1.6 million, because I think it's easier looking at a graph going from left to right. So you can see that the business is gradually increasing, albeit on a very small trajectory, that the sales are increasing. You can also see that the break-even sales are increasing. Now that could be good or bad. What it means is that if your break-even sales are increasing, it means that the amount of costs that the sales have to cover are increasing. But actually in this case, it's not such a problem because we can see that the sales are increasing. So you would kind of expect that the overheads would increase in line with that, but that's something to be aware of and to watch. You can also see that the gross profit margin is on a slight increase, so it's improving over time. And this is gross profit margin in terms of percentages. So this is the actual amount and this is the percentages. And you've got the same scenario with your profit or loss before tax. So you've got the actual amounts and the margins here. And with this, you can see it's declining. So is this a good business to buy? I think what you need to do is to have a look at whether this business is having problems. Are they losing customers? Is their customer service lacking? Have they lost key employees? But it directs you to have a look at that area of the business. If you go forward with this, if you can agree a purchase price with the seller, and this can direct your due diligence. There are two final graphs, one of which is your depreciation and amortization, which is on a decline. Now, declining depreciation is not always a good thing. And the reason being is because it implies that the business owner may not actually be replacing its assets, because each time you get new assets, depreciation tends to increase. So it could be that some of the assets are getting old and you may have some capital outlay to happen. So you would want to be careful when you're looking at the due diligence of the assets of the business to see how old the assets are and whether the business is about to have to pay out a large sum of money. Also, we can see that dividends have remained stable, except for the year 3 scenario where we know it made a loss. So that's understandable why, where the owner didn't take out the dividend in that year. So now let's have a look at the balance sheets by putting in those balance sheet years too. So now that those numbers are entered, you probably saw that I'd got a couple of differences there, and that's that control total to make sure you input the information correctly. So I just had to correct those numbers. So you've got your balance sheet report here, and then you've got your various margins and ratios shown below. So the first two is your current ratio and quick ratio, which is your proportion of current assets versus your current liabilities. And in this case, it's all green, it's all very good. And your quick ratio is your current assets less your stock versus your liabilities. So the next one you have is your inventory turnover ratio. So in this case, year 1 is 6.42. So that means that in this case, you're turning over your stock just over 6 times a year, which ties in with the days of inventory. So in this case, we're holding our inventory for roughly on average 57 days or nearly 2 months. So that ties in with your inventory turnover ratio. And this isn't a bad ratio, it's actually quite good. The higher the inventory turnover ratio, the shorter the time the stock is held. But you have to be careful if that's too high, you could have stock outs or you run out of stock. So you're not going to have enough stock to supply to customers, which is not a good thing either. So it's a balance. You've got a debt to equity ratio, your accounts receivable turnover ratio, and your accounts payable turnover ratio. Now, one of the things that you could actually improve here, although having said that, there's an adjustment I need to make to the setup, is to put in the VAT rate for the business. And I'm going to assume everything is at 20% because that affects that ratio. So coming back here, you can see that's now reduced that to 40. But actually, that's quite high. So it means that on average, by the latest year, it's taking the business 40 days to collect what is owed by customers, but actually it's having to pay its suppliers quicker. So that would be a quick win in terms of improving cash flow to reduce that down to hopefully 30 days or less. Below that, you've got similar ratios and graphs as I showed you with the profit and loss. So the first one is your cash balances. You can see that's increasing over time, which could be good or bad. It could mean that, for example, when we looked at the depreciation was dropping down, which could imply that they're not investing in equipment as much as they should, which is building up the cash. So it might be that you might have to earmark some of this cash to be retained in the business if there's a big amount of money needed to be spent on equipment. Total loans due, you can see that's on a decline, which is a good sign too, that they're not heavily dependent on debt. Shareholders' funds are increasing, so it does mean that although in one of the years there was a loss, your shareholders' funds are increasing over time. Your debt to equity ratio is reducing because obviously your loans are decreasing. Then you've got your stock and work in progress, which is increasing over time, albeit by not a big amount of money, but it is increasing. That would be a worrying sign if the stock is building up, because it could mean that there's some obsolete stock. But you can see that the stock turnover ratio is remaining relatively stable. It dipped in the second year, but you can see that it's actually remaining fairly stable. In fact, it's dropping a little bit. So that's in line with how the business is increasing in size. And similarly, you can see that the days of stock is on a very, very slight decline. Accounts receivable is on a slight incline. Trade creditors or accounts payable, that's increasing over time. We've also got the current ratio and quick ratio graphs too, to show that these are improving over time, which is a good sign. But then the final one, which is the fixed assets, and you can see that equally like the depreciation is decreasing, your fixed asset net book value is decreasing quite significantly over time. So it's gone from £261,000 to £159,000. So it's reduced by £100,000, which is your depreciation. So has the business owner been putting money aside in cash, paying out dividends in preference to reinvesting in its assets? That would direct your due diligence to see when they last purchased those assets. Are those assets becoming tired or worn out and need replacing, or major repairs? So that's something to watch out for, because the last thing you want to do is take over the business and within the first few months, or even within the first 12 months of trading, that suddenly you've got to come up with a lot of money to pay to replace those assets. There are other functions within AcquiCount. For example, you might want to put in what your costs of acquisition are going to be. So legal fees, let's say that's going to be £10,000 in this case. There may be bank fees or lending fees if you're borrowing money. Accountancy fees if you're getting an accountant to do the due diligence for you. And I would estimate that at, let's say, for this business, £10,000. Or accountancy fees, financial assistance. So they will help you work out how to finance the business. Loan broker fees, valuation fees, and any other fees as well. You can also change the currency symbol. So everything has got pound signs because we've selected pound signs. You can change that to dollars. So everything within the reports, at the top of the balance sheets, financing will all turn into dollars by changing that. Let's just change that back to pounds or euros. Or if your currency is not shown here, you could just put your currency in and then it would show up here to be in that drop down. So now that we've entered all the numbers, we can also have a look at the other options for profit for valuation. So if I look at the drop down here, we've got adjusted EBIT or adjusted EBITDA, and that will jump between these two. And we've already talked about how there's a big difference here between valuation using EBITDA, which has now been switched to, versus EBIT, and that would pull through into here. So now we've suddenly, by changing the valuation to EBITDA, we've now got another £120,000 to find for that business. The other options are you've got your average adjusted EBIT and average adjusted EBITDA, or weighted adjusted EBIT or EBITDA. So let's have a look at the average. So what it does is if I stick with EBIT for now, so it will move on to these columns here. So what it will do is it will average it over the number of years that you choose. So in this case, it'll be exactly the same as your base valuation here, because I haven't put anything in there. But let's say we average it over 5 years. Let's change that to 5 years. You'll see that these numbers change. So it's averaging out those profits over the 5 years. So that gives you a slightly lower amount to pay for the business. And this is quite important if your profits have gone up and down and you want to average those out. So in this case, if we went with a 3 times multiple, you're looking at a value of 373,443 instead of the 498. And then the final one would be the weighted adjusted EBIT. And this, let's just move that out of the way, you can give a weighting to each of the years. Now you could argue that the most recent year would have the highest weighting. So let's give that, say, 70%. And let's say the next year is 20%, and then the third year is 10%, and then the last 2 years are 0. So you're only actually bringing into the equation the 3 years, years 1, 2, and 3. And now you can see that this is now green, and it will highlight that year 1 is 70%, year 2, 20%, and so on. But again, similarly to the average, it's reduced the amount that we potentially pay for that business. And in this case, we have a loss in year 3. So in that case, we could be fair to the seller, and we could come back to the valuation and say year 3, we're going to put 0 in there. And we could say 25% there, 25% there, 25% there. So we're actually giving equal weight to the 4 years that are normal years, and we exclude year 3. And in terms of valuation, that gives you quite a fair valuation. So in this case, it's slightly lower than the 498, but that could be a good argument to run with the seller when you're negotiating. So you've got various ways of changing that. And then if you wanted to change that to EBITDA, if you think EBITDA is the right way to go, that will give you a higher amount of money to £634,000. Could take that back to adjusted EBIT. So if you have any questions on how AcquiCalc works, or have any other questions relating to how you finance the acquisition of a business, please drop a comment below. Or indeed, if you have any questions on how to value a business and how this template does that for you too.